Good morning. It is so lovely to see so many faces bright and early at 8:30 after the Thursday night out. So thanks for being here because we're about to talk about one of our favorite topics at Fidelity right now, ETFs, as Dave alluded to. And actually, he stole my entire first question with his intro, but that's okay because there's lots more that we can discuss. But to kick things off, you have been the face of Fidelity ETFs for quite some time now, and we didn't think that his face was, on social enough, so we decided to make him a YouTube channel as well. So those of you that want more Étienne on the weekly, you can tune in to Ticker Talk. So it's his podcast/video that you run, having a lot of great internal, external guests talking about various different topics as to what's going on in the markets, in the ETF world, in the industry. So please do check that out. The QR code is right there on the screens. Please join us. So that'll be a lot of fun. So to kick things off, Dave just alluded to it. ETF growth has been huge for Fidelity, but also for the industry. So it's been great that we've been a participant in that space. You have been really with us from day one and seen this growth over that time. We've crossed the $21 billion mark. Walk us through, maybe in your own words, how we got there.
Yeah, no, absolutely. And it's great to be here. It's great. I guess it took us a full day to get to our topic of ETFs, which we're really happy to be here and share some stories with you guys today. But it's been a crazy journey. And I think when we go back to 2018, obviously, for those that have worked with ETFs for a long time or that have been in the business for a long time, like ETFs have been around for a while. Mm-hmm. And the real growth of the ETF industry started, I'd say, post 2008, 2009. There was some type of, I guess, demand, but also interest in strategies that were traded or vehicles that were traded differently than a traditional mutual fund. Not that mutual funds were going away by any means, but that's really where the growth trajectory started for the industry. So obviously, we're 10 years after that kind of initial boom. So the objective was to say, how can we do things better, right? Or how can we change or how can we come in and have an impact as one of the world's leading asset managers? And really what it came down to was to say, we're not going to go the passive route. There's, hundreds of those types of products. Let's focus on what we do best at Fidelity, which is to add value, right? So we wanted to launch ETFs that our objective was aligned with our active managers, which is to generate alpha. Mm-hmm. So I think it's a strategy of product differentiation, not cost differentiation. I kind of repeat that at most conferences that we do. I just think it's the best way to describe how we've built the lineup over the years.
There's that misconception sometimes, right?
Yeah, there is. And another big thing that we've kind of battled with, if you will, is to go and meet with advisors and explain our story and to say, just because it's called an ETF doesn't mean it's tracking the S&P 500, which, obviously those are some of the largest ETFs in Canada and in the US and the world. But we want to show kind of the quantitative work that we're able to build out, as well as, now we're bringing some of our active managers into ETF series, and we've seen the phenomenal growth there as well. Fin, so that's the Global Innovators product that's now over $1 billion in assets as well. So there's demand for the ETF vehicle as much as our quant strategies that have been really kind of the initial growth of the lineup. And
I don't think that the hoodies have really been that bad of an addition as well. So many of you might have seen the ETF hoodies walking around. You can get a Fin and all-in-one. Lots of fun that we're having there, showing those tickers off.
I don't think I was allowed to wear it here, but I wore it. I wear it for my podcast once in a while. I guess Mark repped his at in the Toronto Vision event. Yeah, I got my all-in-one one. So
lots of fun. So that's a bit of the history. Like you said, we do active management here at Fidelity, and that's why it made sense to do active management with our ETFs and what we're focused on now. So more managers coming to market. We've all been watching the Blue Jays, TSN, you're all familiar with. So what was the TSN turning point really for, our Fidelity ETFs? Dave alluded to it at the beginning.
Yeah. No, there's like multiple things you can point to and say, okay, that was a really important launch. This was a really important launch, but really, like, in terms of a hockey stick moment, really where we started to gain a lot of market share was when we had launched all these great products and we're able to package them together with really the growth and then also the track record that we built out with our all-in-one ETFs that we started launching in 2021. This year alone, they represent more than 2/3 of our total inflows, which has been a record year for us. So obviously, thank you to everybody who's participated in that. Of the $9 or so billion that we've brought in, it's close to $7 billion that's into the all-in-one ETF. So that's really been, I think, the main driver. But
And we'll talk way more about the.
Yeah. So I won't steal all your questions yet.
Excellent. So ETFs, you just mentioned it. ETFs, typically people think passive, right? That's where traditionally that market was built upon. But we are seeing the growth in the active space and the factor space, and that is where we chose to enter and play. Maybe explain the differences in the management styles, just for those, that are familiar, but also that want maybe a more in-depth understanding or analysis of that.
Sure. And the way that we look at it, obviously, it's kind of these three main management styles. There's, kind of the two ends of the spectrum in passive and active. And then obviously, maybe I'll take a bit more time with regards to what factor investing is. But, just if we start with passive investing, what you're doing is you're selecting stocks based off one criteria, right? So there's only one metric that you're taking into consideration when selecting those stocks. It's size, it's market cap. And, we've had the chance to listen to a bunch of great PMs over the last day, and we're going to hear from more later. Very rarely would you hear somebody say, I bought this stock because it's bigger than this one.
Right.
That might be the case in certain situations, but that by no means should be the driving or the leading driver of performance for a given stock. And on the active side, obviously, not to get into too much details what that is, but all of our PMs, the way that they're able to generate alpha over time is by changing those market caps.
Right.
So everybody has a benchmark. Everybody's got a target that they're trying to achieve. They want to outperform that. Well, in the most simple way, the way that you're able to do that is by changing the weights of that index. So either removing a stock completely, overweighting it, or underweighting it. But you're using hundreds of fundamental characteristics or metrics or ratios to determine which ones do I want to own more or less of. And that's obviously, teamwork. It's obviously analysts across the globe looking at all these financial statements, meeting with management of companies. And obviously, it's a very, challenging task. And then in between, with regards to factor investing, is the idea is to say, what have we learned from both of these, and how can we potentially get the benefit of both? Because there is benefits to both, right? And I think that would be kind of, I don't know if it'd be honest to say that there is no advantages to each one of the management styles. Obviously, we are biased towards active and factor because we see the value add we can generate, but we do also realize the attractiveness of a very simple, less sophisticated, yet very cost-effective approach. So with factor-based investing is to say, we learned all these great insights from our active managers. Can we apply those in a systematic way, right? Can we use those learnings and select stocks based off of X, Y, and Z criteria consistently, and is that going to allow us to outperform? And that comes in the form of value factors, quality factors. Quality, another word that could be used, could be like profitability to a certain extent, earnings quality. And these are all metrics that we can really just look at and pick stocks based off of.
And so that's kind of how you would take those factors and make them a bit more active, is kind of what you're getting at, right? That's how we use factors to be active.
Yeah, and I'd say where the real uniqueness of our factor approach comes from is, if I look at, many of you have probably had the opportunity and the chance to hear from Bobby Barnes, who's our head of quantitative index solutions, who's basically kind of created most of our factor indices that we have. When he started at Fidelity, he was working on the active side, right? So he was working with managers like Will Danoff. He was learning from what do you look at to evaluate, a good value opportunity or a good quality business. What are the metrics that are important to you? And not as much relying purely on academia, which, a lot of our competitors will do, and kind of rely on those classical FAMA French models. I don't want to get into too much details. We're the first session in the morning. It's probably not a good idea to talk about CFA journalist stuff, but
try to keep it a bit lighter.
Yeah. So basically you learn from that and then you adapt the strategy to it. So an example I could give, for example, is in our momentum factor. We're not just looking at performance. We're also looking at, short interest. So we don't want companies that are being heavily shorted. We're also looking at, do these companies consistently surprise on their earnings? That's not the traditional definition of momentum, but have shown great validity in helping us pick these stocks that have strong momentum. So these are all little things that add up to lead us to have stronger performance.
So there's like you said, there's all these different nuances, all these different metrics that you guys are constantly monitoring to ensure that we are giving the most optimal performance. You made an interesting comment there. You talked about how Bobby Barnes' influence in designing these factors isn't necessarily all academia, but working quite strongly alongside Will Danoff. We all saw Will here yesterday, a true legend, if you will, of his time. Maybe expand on that in that relationship between Bobby and Will and how Will's influence has come over to the ETF side of the business.
Sure. I mean, I'm not privy exactly to the relationship that they had, but
the story
Yeah, no. So the story that I know is when Bobby started, he was Will's quant. Right. So, and a risk analysis is the biggest work that's done there. And then, the idea of creating these factor indices really stemmed from, okay, this research that you're sharing with me is really helping my process. And can we now branch out and create these actual investable products that will lead to, strong results? But that's pretty much as far to the extent that I know of the story.
But I think there's a lot of key lessons there in the sense that he took really the fundamentals of active management and was able to translate those in different ways to make sure that we weren't losing the foundation of what Fidelity has been built on.
Absolutely. And then it's also a lot of the academic research comes from the late 80s, early 90s, and markets have changed a lot since then, right? Central bank policy is completely different. You have a lot more, intangible assets on balance sheets, for example, and that's just another example I could bring up with our value factor. We look at the price to tangible book instead of just price to book. It's like these small, minute details. Once again, if you just add all of those up, that's where the strength of the process comes in. But it is because it's been adapted to the times due to active management.
It's very exciting. I will also just remind everyone here in the audience, as well as those online, please ask your questions. This is your time to have our ETF expert at your fingertips. So please put it in the chat, use the QR code for Slido. Let's pivot into the industry a little bit before we get too granular. So we have seen tremendous flows into the ETF industry, and you have your finger on the pulse as to what's going on. So what are you seeing in terms of, just this wave that has been coming your way?
Yeah, it's been, for those that haven't kept up with it, it's been a record year for the Canadian ETF industry. Once again, all providers included. We're talking about $86 billion of net new creations in Canada. Last year was about 75, which was the previous record. And we're at 86 at the end of September. So it wouldn't be crazy to think that there'd be $100 billion of net new money going into ETFs in Canada this year. And there's, some things that really stick out in terms of interesting kind of trends or, areas of the market that are garnering more interest that may be newer. U.S. equity ETFs have really been the main driver, I'd say, over the past 3 to 5 years, understandably so because of the performance that we've seen there. But this year, international equity ETFs are one. We've also seen a lot of growth on the levered ETF side. That's something that's quite interesting. I think that is also, those are products that are, have historically been used a lot more by kind of the discount brokerage type of investor. These are things that are maybe a bit more meant for trading purposes and not so much like as a buy and hold. But that's an area that's grown a lot. We're talking $1 billion in September.
Wow.
That's non-negligible.
That's incredible.
The multi-asset category, right? Where this is really where we shine. We make up more than 50% of the flows of that entire category, and it's crossed $50 billion in total assets this year. That's kind of the ETF portfolios of the world. So each provider will have their own. We think we have the best one, but that category's been, and that category, what's really interesting is it's just been completely steady. It's like every month you'll see a couple $100 million to close to $1 billion, and it's just consistent. Very much aligned with the performance of a lot of these products.
Interesting though to see the depth that's happening though, right? Between US, between levered, between multi-asset. Obviously, just the traction it's demonstrating is picking up and really becoming impactful. You mentioned international equity ETF, and also we have a lot of ETFs. So trust me, you're not alone if you can't keep up with all of them. That's why we have Étienne and his team to assist all of you with that journey. But take us back to the international equity ETF. It's selling very, very well. We heard from Patrice yesterday, some of our other global managers. That's obviously been an area of interest. I'm assuming you're seeing the same thing on the ETF front.
Yeah, absolutely. So we're definitely seeing demand for international products. It stems from I feel like it's a number of reasons, and obviously I'm not going to speak for our active managers. Probably highlighted some great opportunities that they've found overseas in terms of stocks. From our perspective, when we look at it, just kind of more, I don't want to say bigger picture, but just to say we work with advisors across the country, and one thing that we have noticed, obviously due to performance, so whether it was intentional or was just a result of performance deviations, is that international relative to the size of that market has been very small weight in a lot of portfolios, and that's been rewarded by having overweights to the U.S. notably, if that was the case. So you've seen kind of a rebalancing effect happening where, okay, maybe I was, a bit too low in terms of allocation of my portfolios. I should be adding international equities a little bit just to make sure that I'm not, if we do see somewhat of a longer term shift of U.S. exceptionalism, which is kind of a term that gets thrown around, if that's maybe fading a little bit, well, I need to be elsewhere other than just North America. So that's one thing. The second, we've heard, I feel like I've been at Fidelity, it's my 9th year. We've been told every year that international is a cheap market relative to the U.S., but you need some type of catalyst for that to reevaluate. And I think, everything that we heard at the beginning of the year with regards to normalization of fiscal spending, monetary policies getting easier, those are all kind of bigger tailwinds that hopefully reflect themselves in terms of earnings. So one of the main things, anyways, from a factor perspective that we look at is earnings revisions, right? So how much are analysts, how much more positive are analysts getting relative to the stocks that they cover, or how much more negative are they getting? And we saw at the beginning of the year is off of the back of this news, the earnings growth expectations gone significantly higher. And actually, it was the opposite was true for the U.S. And then post-April, it just flipped back again. But so I think that's a couple of the reasons that we've seen there. And what's interesting is what's driven the performance of the international market. If we look at, say, the MSCI IFI index, it's completely different than what's driven the performance in the U.S., right? It also means different products worked or different factors worked.
So different or more diversification, if you will.
Yeah.
It's excellent to see.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So we have some international options on the ETF lineup. Let's maybe use the whole word and not just the tickers, because the tickers get very confusing. So which ones make sense, and which ones make sense, now, today, as we enter, Q3, Q4 here for the end of the year?
Yeah, and I always kind of try to go back to when we think about using individual factor ETFs. There's kind of 3 ways to go about it, right? So there's strategic exposure. We know that if you consistently invest with a value tilt or factor, it will generally work over a longer period of time. Then it's more of the tactical approach where it's okay, given where we are in the cycle, given where, our perspectives are from an earnings growth, objectives, certain factors will work well. And then the other is portfolio construction. But if we're going to take kind of the tactical approach, what's worked this year is more on the value side, which is also in tandem with the momentum side, which is the complete opposite of what's kind of the momentum's worked in the US, but it's not value at all. It's more kind of growth names, AI kind of driven rallies. But on the international side, so that's one. FCIM, obviously, I think that if we continue to see that narrative, our Fidelity International Momentum ETF.
There you go.
So that product, I think, is well positioned right now to benefit from some of those tailwinds that I was mentioning earlier. But if I was going to take a bit more of a step back and just think of a more core approach to take for the long term and not trying to time certain factors at any given point, a year and a half ago, a bit more than a year and a half ago now, we launched our all regional equity ETFs. So as much for Canada, US, and international, where we bundle for you, similar to the idea of our all-in-one ETFs, we bundle our 4 main factors together and consistently rebalance them for you. So our all international equity ETF, ticker FCIN, that one I think is a really more kind of set it, forget it, core allocation international. And I guess the last point I'll make with regards to that one and why I specifically like it is because it's shown to be the most consistent in terms of its alpha generation anyways when we're backward looking. And this is obviously with an asterisk, it is backward looking. That's what you can do with some of these quant strategies. It's been really consistent in beating the benchmark. And the main reason for that to me is that it's just such a broader market. I looked it up this morning to make sure I wasn't saying any random numbers, but the largest stock in the MSCI IFI index, ASML, is 1.9%.
Interesting.
Very far from the weight of NVIDIA. So what that allows us to do is to create a much larger active share and allows us to differentiate away from that benchmark to find these better opportunities relative to, say, an index like the S&P 500, which has gone very concentrated.
Well, and like you said, you're really capitalizing on what Fidelity can do for you is essentially package, 4 of these products, put them together, rebalance them for you, but then you're not having to make that one decision on one ticker necessarily. It's allowing you to have a little bit more diversification.
Absolutely.
Benchmarks.
And once you've packaged these 4 factors together, what you end up having in terms of a feel in your portfolio is something that's going to be very correlated to your benchmark, right? The objective is we go up a little bit more and down a little bit less. And we're not trying to, shoot the lights out in a given year or, and definitely avoid years where we underperform materially. And so if we look at, say, the last 10 years, I think the correlation is about 0.98 to the MSCI IFI index. So I think it's going to give you a more kind of consistent experience.
A smoother ride, if you will.
Yeah, definitely, at least if you're looking at it on a relative basis, right? Where you're never going to be completely in or out of it, right? So I think you're completely in it, not out of it. Yeah.
Great. Amazing. So since April, we talked a little bit about this, but it's like we've gone back to favoring things that have maybe worked back in 2023, 2024. Mega cap tech has been a huge conversation, continues to be a huge conversation as everyone's trying to figure out where does that go? Where does that land? But that's been translated. You mentioned this, the performance of the US ETF factors have done extremely well. We've talked a bit about international. What's your view on the US side of things as we enter into 2026?
Yeah, and I think the best way to describe this year is that we've seen already 3 distinct phases from a factor perspective anyways. So when we started the year, our ideas and perspectives and thinking was that what worked last year, which was momentum and quality, there wasn't really anything indicating that should change to start the year. And the way that's kind of the analysis is conducted is we look at various different macroeconomic metrics and say are we going to change cycles? And we're not obviously monetary policy experts. We're not an asset allocation team, but actually Bobby's team builds out a really great model called a deja vu model, where you look at 20 different metrics and say where this end of month, what other end of month in the past does it look like, and does it not look like? And basically it was screaming late cycle, right? So late cycle factors, momentum, quality, those were kind of the idea. And that really worked for the first 2 months of the year. And then obviously you have the tariff tantrum and that just completely flips, right? So what worked then became low volatility, value, dividend, basically everything that didn't work became really strong, and then momentum really fell off because that was the first thing to kind of go. A lot of the large cap tech names, obviously the semiconductor space got hit hard, et cetera. And then we got the 90-day tariff pause, and that's really been the kind of the name of the game since April, which is a beta trade. And the only thing that's working is momentum. And that's actually a challenging environment for us. If you look at, either our all-in-ones, our all-American equity ETF, when we're packaging like multiple factors together, it's tough because when you have only one factor that's really strong, it's very different from a regular year where you have an average of 2.7 factors that usually outperform. So let's call it 2 to 3.
Right.
So obviously we're very happy to have momentum in our products, but it's really challenging when it's a full-on beta trade, when the chart's going all the way up to the right. But that tends to normalize. And that's very atypical of the early cycle recoveries and these kind of euphoric recoveries in certain spaces. It reminds me a lot of like the early 2021 when we had the meme stock rally. Like that's not a great environment for us because you got companies that are expensive, unprofitable, didn't really have momentum because they were selling off, and they're volatile. Like that's the anti-factor period, and those exist.
The anti-glamour, as Ramona would say yesterday. We're going to pause on the U.S. side for a second because we do have a question from the audience. How are ETF flows reflecting investor sentiment in the current market? So taking us maybe back to the industry a little bit, talk about how the investors are doing.
It's a great question because I actually tie it into what I just mentioned with regard to it being a beta trade. Like the flows are very reflective of risk on. If we remember 2 years ago, the number, like in the top 5 selling ETFs in Canada, you had 3 cash alts, right? Like you had high interest savings ETFs, money market ETFs. That demand has evaporated. There's not a ton of demand for fixed income, albeit, last month you could look at the number and say it looks big, but there was a single ticket $1.2 billion trade by an institution into a fixed income product. But if you take that out, there's not much demand. So I think that's just more reflecting not too much interest in defense right now. And, if you're a contrarian, maybe that's,
it could be an opportunity there. You got it. Let's go back to that conversation, or stay on it, if you will. So the U.S. concentration we've seen, it is just really with a couple handfuls of stocks driving that momentum trade, as you said. Is there a specific factor that can offset that when you're looking at, those sizable allocations to the S&P 500?
Yeah, definitely value would fall into that camp. So our U.S. value ETF would be a good option. You're very rarely going to own as much of the top of the index. Just generally speaking, those are expensive names. So that'd be the option there.
Okay, value it is. And then for someone that's considered, an equal weighted approach to the S&P 500, so, spread evenly across the portfolio, how might our approach differ from someone that's looking to do that?
So I'll try to keep it short and sweet. The way that we differ is that we're not, like, if we look at our All-American Equity ETF, which I mentioned a bit earlier, where we're packaging the factors, we're not taking on significant bets. Like an equal weighted index, you might think, I'm getting the same 500 names. You are taking on some big bets on size, on value, and anti-momentum. You're betting against momentum. So I think it's just being conscious of that. If you're looking at an equal weighted S&P 500, which has been a fairly popular way to diversify away, say, I want to take some risk off the table onto the top of the index. It's just, I think you're not necessarily getting exactly what you expect sometimes. So just look under the hood. Our portfolio strategist team sitting right outside. You can ask them after.
I was going to say, and actually that's almost a great lead into the next question that we just had come through around investors. Are they using ETFs for more tactical positioning or longer strategic allocations?
Yeah, so that's both, I guess, right? It's, definitely both. Definitely both.
Okay, excellent. I'm excited because I would say this is one of our favorite topics to talk about is our new all-in-one suite. So this is something that came out a few years ago. We've really seen momentum pick up. Like you said, I believe we're over 10, 11 billion now into the all-in-one suite. As our president, Rob Strickland, would quote, this is your lightning in a bottle. And that's not only something that you can all take away and start using in your everyday practice, but something that I've taken away today. We're really excited about this suite because there's a lot of potential that it does have in really being that one-stop shop for investors to have a really diversified, balanced access, if you will, to a suite of ETFs that Fidelity has put together. So let's talk about the building blocks within all-in-ones and kind of just start at the beginning.
Sure. No, so I mean, these portfolios are really the culmination of, as we mentioned at the top, is 7 years work now to get all the necessary components to build these fully diversified portfolios, not only from a factor perspective, which we've talked at length about, but from a geographic perspective, from a market cap perspective, from an asset class perspective as well, right? So we do include a small sleeve of cryptocurrency as well in these portfolios, and the idea was to be strategically managing very core portfolios, but to win on, the sum of all parts in security selection. Right. So if I were to, compare this to a lot of the notable competitors in the industry, what we find is that we're looking to try to do, to get the top decile of the world market, right? So if our products here will hold between 2,000 to 2,500 underlying securities. That is about the 10th of, some of the notable competitors. And another way that I look at it is, we're trying to not necessarily say we're going to pick the best stocks at all times. I don't think that's, it's not possible. Otherwise, there'd only be one reason to invest or one way to invest.
Exactly.
But one thing that we are able to do very well with these products is to say, what are the undesirable names? In those 20-some thousand holdings, it's much easier to determine which ones we don't like than to pick the best.
Right.
And I think doing that approach and repeating it over and over and over again, which is what we do with our systematic rebalancing in the products, leads to really strong results.
And that's an interesting comment, because that's a theme that we heard yesterday as well with Will, and maybe that's been translated, is you have to know the entire universe and know where you don't want to be to also know where you want to be, right?
Exactly. And it's kind of like a metaphor that I use is, you go to the grocery store and you buy a bag of apples. It's pretty easy to see which one's rotten in there, right? So you probably don't buy that bag.
Yeah.
Right. So, and I won't get into the whole, I can go another step into the metaphor. Usually that apple's going to, contaminate the rest of the bag. So just get it out as fast as you can and, move on. That's really the idea that we have with these portfolios. And, the systematic rebalancing aspect of it means that you're getting a consistent experience. You're also getting maximum risk deviation. So if you're, using a balanced product for your clients, it's going to remain a balanced product. We're not only, doing that rebalancing once a year, but every day that we're getting inflows and outflows, we're managing that to try to get back to our neutral mix and to stay close to that.
So I don't think anyone's going to go to the grocery store and look at apples the same way. They're going to view them as ETFs, rotten,
broken
bad,
eggs,
broken eggs, whatever you want to think about. But rebalancing, you did just mention it there, so it is daily, is what you just said.
Yeah, inherently because of flows, but there is a fixed, rebalancing date where we go, okay, we're going right back to the neutral mix. And, from an asset class perspective, we can't deviate by more than 5%. For Bitcoin, given its volatility, it's no more than double the base allocation. But that's really just done in order to make sure that we're respecting the choice that you've made for your investors.
But the beautiful thing about that is that rebalancing is something that takes time, and that is time that essentially we can offload and make more time for other activities.
Yeah.
Which is excellent to see. You just mentioned Bitcoin. I think Bitcoin is a really exciting part of these portfolios because there's a lot of investors out there that are very interested, obviously, in crypto. They're very interested in getting in. Some are, 2 feet in, some are a toe in, some are not in at all. But this is a way to give them that exposure while diversifying and mitigating the risk as well. So just maybe touch on why Bitcoin was included.
Yeah, I mean, this is, something that obviously we took a lot of time to think about, right? You're adding an asset class that has a volatility that is significantly higher than your traditional equities, traditional fixed income. But then, when the more you think about it, the more you have to just look at it as a security, which is, kind of what it is. Obviously, you are reliant on past data, but the things that were very evident to us when considering it is Bitcoin has gone through multiple boom and bust cycles, right? So understanding and respecting the risk profile of that asset class is, primordial. So when we looked at it, basically adding, granularly 0.5%, 1%, 1.5%, like how much can we continually increase the Sharpe of a traditional 60-40 with the help of Bitcoin without then overtaking kind of or getting dominated by the risk profile of the portfolio. So doing multiple different scenarios where we have a 2022 where Bitcoin's down, 70% or so in Canadian dollar terms. Well, even in that year, the rest of the portfolio and the great work that's being done there is more than enough to compensate for that risk that we can take in those bust cycles. And then obviously in years where Bitcoin is, having better performance, well, it's going to be additive to the portfolio. But I think we really looked at it from a kind of a marginal returns. Like how much can we add until we get, positive marginal returns, and then we stop. And that's basically the 0.5 to 3%.
And maybe just to ease concerns, the cap on that again?
The cap?
Yeah.
So it's double the base allocation. But once again, because of the inflows that we manage, you never really get close to that. So even a year like 23, 24, where Bitcoin was up significantly, we weren't more than 1% deviating from the benchmark.
And a
for
question,
the neutral mix.
Okay, that's great to know. And then just another question that I've heard before, Bitcoin's there, but there's also other currencies available, other cryptocurrencies. Would that ever be under consideration? Was there any, thought around that?
Yeah.
Just two cents on
It's
that.
been considered. I think the main thing that we can take away from that, I think, is Bitcoin continues to be the more kind of stable and largest cryptocurrency, and I think most widely accepted. So when you're adding other alternatives, not to say that they're not good alternatives, they also have very high correlations among another. So for us right now, it just made more sense to leave it at Bitcoin, but it's something that we could, it can be changed. These portfolios are not fixed in stone for the next 25 years. So.
And evolution is what makes them great, right?
Absolutely.
Emerging markets is something that isn't represented in there. Maybe tell us why.
Yeah, no, that's a great question, and that's another, I think, segment that we're consistently looking at, trying to find, is there a way that we can do it, and it's something that could be added in the future. Not, that's once again, we're constantly reviewing the portfolios, but I think the thing with emerging markets, similarly to small caps, which we do have, our global small cap opportunities ETF as part of an allocation in the portfolios. That's a place where active management really shines.
Absolutely.
And it's, once again, it goes back to what I was mentioning earlier with regards to high active share. And now I'm going all the way back to academia, but like high active share managers have shown historically to have stronger alpha, right? And you can see it in the numbers relative to their indices a lot of the times. And so for us, it's just, if we have a good option, then it's something that's going to be considered for sure. But we weren't looking to go and add a passive index there.
Excellent. Since we're talking about all the things that were under consideration when building these portfolios, touch on size and dividend. Essentially, why we don't include those.
So, well, we include size, I guess, on the active side, not on a factor side. For dividend, the way that our dividend products are constructed is heavily reliant on yield, right? So 70% of the score for scoring the stocks is yield, 15% on growth, 15% on payout ratio. So when you're doing that, you are getting a lot of similarities with the way that we select stocks for value. So you actually get a lot of overlap in dividend and value. And hence, if you would be adding both, you would somewhat be doubling down on that style. And value is just shown to be a bit higher alpha over the back-tested data we had. So we preferred value over dividend.
Excellent. So lots of cases. We saw the suite of portfolios available to investors. They were up on the screen there before. But if you do have any questions or want to further dive, Étienne and his team are always available to go through those with you. So let's pivot to performance, because from a construction standpoint, they make complete sense in how we diversify and how we're allocating to where we can capitalize on that. So speak to how these have, been driven obviously through construction, but how have they performed?
Yeah, they've done quite well. We're extremely happy, obviously, with the results that we've achieved. But when I take a look at since inception, let's take the balanced and the growth as the two main examples. Those are the ones that have been around for the longest, and they were last year recognized as the best multi-asset ETFs in their category by the Lipper Awards. Very happy with that. But it's the consistency at which that we've been able to achieve these returns, and through various different markets. That's 2021, which was again tough to start because there was that kind of meme stock junk rally. Then it was followed to 2022 was very high inflation environment. It was now value factors that were working really well because they were overweight to things like energy. Then it's been momentum, quality that's really been leading the way. And throughout these different markets, we've really been able to achieve some really strong and consistent results. And obviously, more recently, it's really been momentum across all regions that's been, really helping. And I'd say, to note of one, slight detractor, definitely be low volatility, because once again, the lower beta trade right now it hasn't been ideal. So I think that's the one slight detractor. I guess one thing I'll debunk as well, because a lot of we all have friends that work at competitors, and I get to bump into a lot of them. And they always try to tell us that it's your guys are outperforming because you're Bitcoin. Yeah. So out of the alpha that we've generated versus our benchmark, it's only about 20%. Since inception, that's been contributed by Bitcoin, which is non-negligible.
Absolutely.
But it's definitely not the entirety of the alpha that's been generated.
Yeah. Well, and we saw there, I mean, peers beaten, the numbers are in itself. And the great news is we'll have a 5-year number coming up soon, which is always wonderful. Question from the audience. Would alternatives ever be included into the all-in-ones in the future? If so, what sort of allocation could they potentially have?
That's a great question. I think it's something that we're consistently reviewing this. Like, we added the small cap component a couple years back. We added 2 new fixed income mandates to start the year. So I guess the best answer I could say right now is never say never. It's not in the plan in the short to medium term, I'd say, but it is something that's being considered. I mean, we are obviously growing out our alt lineup. So yeah, I guess it's an option.
Yeah, and I mean, we just launched the multi-alt strategy, equity strategy on Tuesday. So never say never is what I'm hearing.
Yeah, exactly.
Excellent. Love that. You had mentioned Bobby Barnes. He's been a huge part of launching ETFs here in Canada. Maybe just speak to your relationship with him and how you guys work together, and how, that osmosis of information, really captures the Fidelity way.
Yeah, no, Bobby's phenomenal. And his team, gives us access to data and research that really help enlighten the decisions that we make from a product standpoint. And we have quarterly calls with him. I have monthly calls with Bobby, and it's just a fantastic relationship that we have with him. Hopefully, we'll get him out to one of these events as well. But I think the depth and knowledge that his team has is just best in the world, right? It is really, really true impressive. The different indices that they test, like, that's just another example. Like, they run hundreds of indices. Like, the products we have is just the small subset of all the research that they do, to the deja vu model that I mentioned earlier, which I think is one of the coolest, macro models
also
I've ever seen.
Also a great name.
Yeah, it's great. Exactly. But yeah, no, so I think we're very lucky to have that relationship, and yeah, it's allowed us to have this great product lineup.
And the other exciting part about growth in ETFs means growth for Fidelity, for you, for your team specifically. So, what can our advisors look forward to from you and your team? Yeah,
no, it's been, as assets grow and, as we have more and more asset holders, we expand our team, which is that of the ETF and alt strategy group. We have, my colleague Vince that was joining us this week. Vince Kraljevich. So he's one of our ETF strategists in Ontario. And really our role is to work with, our entire great sales team to make sure that we're communicating, as much granularity in terms of knowledge with our products. We can help you look at, existing ETFs that you use. We can also, talk about our more than 50 different ETFs that we have and how they could potentially fit in your portfolios. These are all things that we do, in partnership with our sales team. And, hopefully we've been delivering some good service there and helping everybody make some good decisions.
Excellent. Exciting things to come. We have to get to rapid fire really quick. So a fun new thing we've been doing before we close out today. But if you had to give factor investing in one word.
Hybrid.
Okay. And your favorite factor right now? I think we know it.
Momentum.
Oh, okay. I thought you were going to say international. Beach or city?
Beach.
Okay. Do you tan?
Golf tan.
Okay, golf tan. Okay.
Nobody wants to see
you. Your go-to karaoke song, if you karaoke.
Well, everybody could hear my voice. I didn't go out last night. It was I have 2 young kids, so everybody knows what that's like. So I'm not going to be doing karaoke hopefully tonight, but I don't know. I'd go with Wonderwall.
Okay, that's a good one. And I always think of this as your Fidelity uniform, but hoodie or vest?
So now I guess we have these new hoodies that you mentioned, but I'm definitely a vest person. As soon as it gets below 15, 20 degrees, I'm wearing my vest.
I love that. Let's just wrap up here. ETFs, tremendous year, tremendous success, a really exciting time for you, your team, for the all-in-ones here at Fidelity. Just final thoughts to leave our audience with today.
Yeah, just thank you so much for being here. Thank you so much for supporting this endeavor. I think you're going to continue to see more innovation from us. We're going to continue to deliver hopefully on performance on the products that we have currently. But as you very well know, we're going to have more great new things coming in the future as well. So thank you so much.
Thank you, EJB. Appreciate it.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.